Alright, welcome to the S&P 500 chart storm run through. So what I'm going to do in this video is I'm going to go through the various charts that I've tweeted out here, and I'm going to take you through the actual tweet itself, and then I'll blow the chart up and then talk through really any extra comments or context or thoughts that I have around it, just to really add a little bit of extra. It's quite free flow. I haven't really scripted this or anything, and also just FYI about the chart storm. So the purpose of the chart storm is just to bring together 10 standout interesting charts that I found around the web or on Twitter, and sometimes it's just a collection of interesting charts. Other times, they all sort of weave together into one bigger picture and a clear market view. And this week, well, I'll let you know at the end of this video what that is. So we'll get on to it. Number one here, S&P 500 index rolling over after putting in a short-term bearish RSI divergence signal, i.e. higher high in price, lower high in RSI. So we'll blow up the chart first. So what we've got here is you can see the S&P 500 index. It's on stockcharts.com. Highly recommend that site. So candlestick of that series there, and really the highlight of this chart is this green line and the red line there, and basically again, higher high in price and lower high in the RSI. So and also, when it comes to actual bearish divergence, you'd call it a tentative bearish divergence if you can see where my cursor is there, if it was just up to that point. But when it's actually rolled over from that point, because you can always get you have a tentative bearish divergence before it rolls over, but if that RSI broke up through that red line, you would call that a bearish divergence being resolved in a benign fashion, or you might actually call it a failed bearish divergence, or a wrong or false one. But anyway, it's fairly clear and plain to see there, price rolling over. So market is in sell-off / correction mode at this point, and as to how far it goes from here, I don't know. We'll see. We'll see if we can get some further clues from this, or whether I think of anything by the time we get to the end. Next chart, number 2. Similarly, updating a chart from last week's session, also saw bearish divergence against the 50-day moving average breadth indicator. Would not call 50-day moving average breadth indicator particularly oversold looking yet. So let's blow it up and unpack that statement. So very similar to the previous chart, and this was actually a feature of last week. So now it's looking a bit more confirmed, a bit clearer this week. So again, higher high on the index or the price, and lower high on the indicator, which in this case is the proportion of S&P 500 stocks that are trading above their respective 50-day moving average. And so at 55.6%, just over half of the 500 stocks, or just over half of the S&P 500 are, and I'm not even sure if it is 500, I'll have to go and check, but are trading above their 50-day moving average. So again, it's the same thing as the previous chart. It's a pretty clear signal there. Just seeing if we can find a previous one here. We've got one here actually. So early 2019, you had a lower high in the red indicator there against a higher high in the index, or just sort of upward line in the index. After that showed up, you did see a decent correction there. So again, once this kind of pattern shows up and gets initial confirmation from price rolling over, then market's in basically correction sell-off mode. What makes the difference between a sell-off and a correction, or actually what is the difference? It's a good question. Personally, I call a correction something a bit bigger, so like let's just say 10 to 15%, and a sell-off, you know, more garden variety, something in the range of 1 to 5%, you know, call it around there. And typically sell-offs happen for, you know, maybe just some sort of reaction to news that doesn't, you know, the news is scary but doesn't really impact things, or just a technical sell-off, like the market's just ran up too far and it just needs a little reset. Corrections can happen for technical reasons as well though, so you know, it might be that there's significant froth in the market that needs a bit of a reset, or it could be that there is some underlying issue that the market has been ignoring or not paying attention to, or something that has just, you know, changed and that the market needs to sort of reprice. And you know, corrections tend to happen more often because of something, you know, significant and actual, like, you know, crappy data, or you know, central bank tightening, some sort of geopolitical issue that's not going away in a, you know, in the blink of an eye kind of thing, or something that's not, you know, that has the, at least the possibility of being bigger. And we've actually got a couple of those things kind of going on at the moment, so there is actually a bit crappy data. I mean, central banks are not tightening, they're doing a lot to help, but you know, the virus is probably something that you could call a geopolitical shock that you know, probably, well, it has the possibility of sticking around for a while, you know, or having a larger impact. So, you know, those are considerations. But back to sort of the tactics, or the, you know, practical aspect. One way that we can tell that, you know, whether a sell-off or correction is going to be over soon is what happens, or the way that this green line actually moves. So if you were looking at market breadth, you know, coming in really low, so like look at the last couple of sell-offs and corrections here. If you see 50 DMA breadth at like 30%, you know, you can tend to have a bit more confidence that the sell-off has kind of run its course there. You know, there's levels of oversoldness. You know, back in late December 2018 rather, it got to below 10%. I mean, that is significantly oversold at that point. And you know, markets can go from, you know, see here, it was like 30% there, so it can go from quite oversold to even more oversold. Just like expensive markets can go from expensive to more expensive. So you know, it's not a magic bullet, but when you start to see indicators showing up as oversold, it certainly adjusts the probabilities. But yeah, we're not there yet. It's middle of the road at 55%. I mean, you know, you'd need to see it below 50% to call it oversold, and we're not there yet. Next, number 3. Sip of my coffee. Speaking of market breadth, here is an interesting stat. We often hear about fund managers not being able to beat the S&P 500, but lately neither can most of the stocks. So we'll blow it up here, which doesn't really help because it's a bit blurry. Anyway, what is this? This is the proportion of stocks outperforming the index, and that's rolling 6-month return window, and that's against the S&P 500. And so, you know, if we just look at where it's at there, call it, I don't know what it exactly is there, but we'll call it 38%. Let's just round it up to 40%. So we'll say this. So on this indicator, 40% of the market, or 40% of the stocks that make up the S&P 500 underperformed the actual headline index. So, well, actually, no, that's wrong. 60% underperformed, only 40% outperformed. So, yeah, that's an interesting chart and an interesting sort of thing there, dynamic there. Basically, it just tells you that yeah, 40% of the market is actually outperforming, and those are the ones that are actually driving the gains. So it's a very concentrated market. You know, in terms of going back to the fund manager thing, like the only fund managers that are going to be outperforming are going to be the ones that have loaded up on the tech names, you know, the ones that are actually driving it. So in this kind of market environment, if you just pick the most popular things, if you just stick with momentum, then you'll probably be outperforming. But if you take, you know, a value approach or sort of contrarian approach, you're probably not doing so well. And that kind of brings us on to the next one there, number 4. It's plain and clear. This is a very concentrated market. So we've got here on the left chart, that's stock concentration. And on the right chart there, it's sector concentration. Yeah, very concentrated market. It's I'm not actually sure exactly what's going on this chart. Oh, let's see, we've got a blurry blurb here. There's a growing divergence between top 1% market cap and net income. I can't see what that is. Anyway, we'll just say, yeah, it's concentrated market. Let's go on to the next one, because the next one kind of expands on that theme. But we've seen a lot of charts floating around like this, and you know, you see the same kind of pattern if you look at, say, tech sector market cap weighting. You know, obviously it'll probably map pretty closely to that. After all, S&P 500 is a market cap weighted index, so it's always going to be the case that if you have like one sector doing particularly well, or a bubble in one sector, then because it's market cap weighted, then the S&P 500 is going to, you know, drift toward more and more toward that sector. And so if you're a passive investor, then, you know, because the investment strategy of a passive investor is to basically buy the biggest stocks, you know, buy the biggest market cap stocks, that means that a passive investor is always going to be over, you know, you might call it overexposed. They're going to increase their exposure to any sector that happens to be in a bubble, or any sector that's just, you know, fundamentally doing well. You know, if you see a structural shift that means that one sector fades into obscurity and another sector becomes the new economy, then, you know, it kind of helps them. That you know, you might call that the good side of passive investing, but the bad side is that, you know, you end up being significantly exposed if one sector ends up in a bubble. So number 5, continued, another one for the theme of the last couple of charts, starting to get real here. So let's have a look. What is this? Grey line is the ratio of tech to energy, and I presume that that's relative performance, and single stock call option volumes. So basically how much flow there is into call options, or how much buying of call options there are. Looks like we don't have that green data back to the end, but I'm sure that it probably would have looked fairly similar. I mean, this is yeah, tech's going nuts, and people are starting to notice, and you know, you've seen retail account activity really spike. Part of that is, I guess, just performance chasing, and it's also, you know, there's been a significant cheapening or opening up of access even further. Like, you know, it's very similar in that respect to the late 90s. In the late 90s, you saw the emergence of the online discount brokers, and that took, you know, that kind of opened up the world of day trading, of stock trading in general, to a lot of punters that, you know, might not have actually considered it before, or might not have had access to it before. So, you know, lowered trading costs in this big sort of one-off shunt. And then now, you know, you've got trading costs have gone down even more, and you've got technology making it even more accessible, like lowering the minimum access requirements, and, you know, all the rest of it. So yeah, quite interesting there. you know, the fact that there are parallels to the late 90s does, you know, give one at least pause for thought. Are we in are we in a stock market bubble? Are we in, you know, .com bubble 2.0? Maybe. Couple of things to note there. Equity risk premium is still positive. It was negative back then. So one thing that's actually different to back then is that the cost of financing is still a lot lower versus then. Monetary policy is a lot easier now relative to back then. So, you know, if you were to copy and paste all the conditions, or, you know, as much of the conditions as possible from this period, except for monetary policy, over to now, I might actually argue that, you know, things should be a lot more frenzied, a lot more hyped up, a lot more frothier now than, you know, they should have been. You know, if you factored in all that easy money as well. So, you know, what do you do with that information? Maybe you say that it's got further to run. And you know, this is probably the phase of the market where we might actually, you know, maybe we do get another 2 years where it extends even further, goes into this even bubblier, even more hyped up market. And you know, in looking back to the late 90s, you actually got a lot more volatility. Like, we've actually had quite low volatility. The market has almost gone up in a straight line. Yeah, a couple of small corrections like we saw in that previous chart, but maybe this is the entry into the last frenzied phase of the market. Something to ponder anyway. Now, back in that previous chart there, we had actually tech versus energy, and this is kind of a different angle on that. Speaking of energy stock relative performance, you know, why I actually see that. This chart is just ridiculous. So let's look at it. What is it? It's energy sector versus S&P 500 relative price performance. And it's going all the way back to the 1920s. Any consideration down here? Monthly data. Oil and gas sector index was used prior to 1990. So, yeah, wonder if it was any different. Well, anyway, might be something that I can go and have a look at later on. So yeah, relative performance of energy. Energy has been an absolute disaster in relative terms. Massive bear market there. It's brought it back down. Obviously, this is extremely interesting to anyone with a little bit of a contrarian, you know, bone in their body. And you know, it was actually quite a similar kind of situation back in, you know, .com. You know, if you want to look for parallels. Back then, you know, energy sector, materials, commodities were doing crap, and you know, that actually created scope for a lot of upside there. So created a lot of opportunities, and surely some opportunities will emerge here at some point as well. You know, the argument against that is that this is a big structural change. It's a new paradigm because, you know, well, what's on the other side of this here? What's on the other side of energy here? Is the explosive performance in tech, which has driven up the S&P 500. Also, the sectors that have benefited disproportionately from easier monetary conditions, like utilities, they've done pretty well. But yeah, it's basically tech versus energy, or you might call it new economy versus old economy. So you know, in the long run, you know, 100 years from now, will we still be using oil? Maybe not, probably not. We'll probably be using something that hasn't been invented yet, or we'll probably be using renewable energy, or, you know, I don't know. Odds are, you know, especially if you get electronic cars becoming, you know, the predominant, you know, the dominant means of transport. If we use electricity as the main means of powering our transport, then odds are that oil won't be our main thing that we use. So, you know, there is that, but is that going to happen in the next few years? Is that going to prevent another cycle from playing through here? Probably not. But yeah, maybe a little bit more water even needs to go under the bridge before that turns around. And at the end of the day, there's also a growth element to it, because oil tends to do better when the economy is doing better, and the last few months, last few quarters, global economy's been in recession, or at least the export and manufacturing part of it. So I'll leave you to do the legwork on whether or not that's a decent trade. Number 7 here, trucking tonnage low on energy. So it's tapering off against the S&P 500 there. So what we've got here is the truck tonnage index from the Bureau of Transportation Statistics, which is calculated from the American Trucking Association. Yeah, so truck tonnage weak, S&P 500 strong. Not much else to add there really. You can make your own conclusion on that. Number 8, high energy. Small traders punting on call options. So this is what we had actually in that previous chart before there. Yeah, small traders are getting after it. They're loading up on calls. Fair enough. I mean, market just keeps on going up. There's risks. So the benefit of call options is that if you buy a call option, your risk is 100% defined, whereas your upside is technically unlimited. Of course, on a call option, guess what? If you have a portfolio that's worth $5,000 and you use that whole $5,000 to buy call options, your loss can be 100%. Because, and that when you do that, But anyway, that's just a passing sort of observation. Let's just work out the maths just to put the counterpoint there as well. If you had say a $100,000 portfolio and you put 5% in call options, if those call options expired worthless, which is very common actually, then you would have 100% loss on that 5%, which would be portfolio loss of minus 5%, just to illustrate the maths and sort of the counterpoint there as well. Anyway, moving on. Number 9, this is interesting. And that's kind of all I could write about it, because it's interesting. So what is it, first of all? The green line there is the share of household equities and mutual funds owned by the bottom 90% by wealth. So take off the top 10% richest people, and this is what you get. Their share of equities owned has been counter-cyclical. Yeah, so there's a couple of things that we could talk about here. It's counter-cyclical, obviously, because the richest 10% own most of the market. They have a higher beta to the market, so obviously when the market is been going good and there's near a peak, they're, because they own more equities, the rich get richer kind of thing. They, that kind of is how that dynamic happens. Then there's some stuff that you talk about in terms of, rich getting richer. I don't know. I don't like to talk about the politics and all that sort of thing. Maybe you could talk about the wealth and inequality aspect and how maybe that can cause some issues. But I'll just leave it for you to think about and for others to take up that conversation. Number 10, last one, which is similar to the previous one. And probably this one's a bit more interesting in terms of, that previous one, maybe the takeaway from that is that it's like saying that maybe we're near a top because it has this sort of cyclical element to it. This one I think is perhaps a little bit more interesting in terms of, what we can do with it on the outlook. Similar note, emotional scars of the financial crisis, a significant chunk of the population gave up on stocks and never came back. So what is this? It's the share of the population holding stocks has not recovered up. US stock ownership, what is it? Do you, personally or jointly with a spouse, have any money invested in the stock market right now? Either in an individual stock or stock mutual fund or in self-directed 401k or IRA. So, well, first of all, let's flip it on its head. At 55%, 45% or almost half of the population do not own stocks. Now, let's keep it in context here. At its peak, it was like, maybe call that 63%. And right now, 55%. Now, okay, that's only, right, only 7% of the population. 7% of the population, though, is actually not that small. I mean, it's fairly significant. And if you look at to where it got to at the bottom there, so just over 50%, we'll call that 51%. So from 63 to 51, that's 12% of the population. That's not small. So basically, you know, if I would say if a material portion of the population gave up on stocks after 2008, call it the scars of the crisis, you know, it took a couple of years for them to fully, you know, get out. So maybe there was an element of, you know, they waited until they earned their money back. You know, the stock market, their portfolio would have taken a big dive then, and it would have sort of come back around then. And maybe once they made their money back, they decided that that was enough and that they'd get out while the getting's good. Meanwhile, these ones, you know, the guys that gave up on the market missed out on a lot. And, you know, maybe there is a demographic aspect to it, but, you know, it is quite interesting. And then I guess the perhaps interesting outlook question is, can it ever recover? I mean, obviously, if you had, say, let's say 10% of the population decide all of a sudden that investing in the stock market is a good thing, well, obviously that's going to be quite interesting in terms of the frenzy aspect. That's going to bring you back probably more into that 2000 period there. Be interesting to see, actually, to push this survey back, if there was actually any further data going back to see you know, what kind of participation it was in the earlier 90s. But anyway, it's a good one to end on. It's kind of leaves you hanging there. But yeah, in terms of market outlook, we kind of covered that. You've got basically a confirmed bearish divergence playing through. Markets rolled over. Obviously, you've got a lot of spooky headlines in the background. Data it started to stabilize, but you know, obviously we're going to get some pretty scary numbers out of Asia probably. That'll start, I think, either late this week or early next week. You know, as you get the PMIs. So yeah, and none of these oscillators have gone into oversold mode yet, where that kind of shifts the probabilities. And you look at valuations are still pretty high. It's going to take more than this little move here to make valuations give you reason to change the probabilities on the outlook. So yeah, if I had to guess, I'd say that we'd probably go a bit lower before we go higher here. And I'll leave it on that rosy note. And actually, yeah, to be fair, I'm not like, you know, a perma bear or, you know, one of those doomsters. I'm try to stay fairly balanced, but you know, medium term, I'm actually pretty bullish still. But that's a topic for another time. So look, if you've got any comments or questions about all of this, put them in the comments section of the YouTube video, and be sure to follow the channel.